Thank you. So as is our tradition, we'll go through just a few slides highlighting the core areas of the report, but we continue to invite you to give comments on the reports, because every subsequent report that we launch, we usually take in comments from participants such as yourselves, but much more importantly is really commentaries arising out of this is our critical concern to us. So I'll go through the slides, but in the course of the presentation, please feel free to send in your comments, questions, and any other suggestions that you may want us to cover even in the next report. But as soon as we finish this session, the report will actually be available for us to access on our website. So in a nutshell, I'll be covering 4 areas. One is on the domestic and the global economic developments, because all of us realize that all this feed into the performance of the banking sector. The sector is so much intertwined with economic performance. Then we go delve into the banking sector developments within 2023 and some of the developments that we have seen in 2024, particularly on the growth aspects, the risks and the mitigations that have been deployed, and then move to look at the profitability indicators that shaped the performance of the industry in 2023. Then, of course, conclude with an outlook, in which case now that enables us to cover the 2024 performance and where we see the sector go into even beyond 2024. In terms of the global economy, I think we all recognize that the global economy faced a number of risks rising from the geopolitical tensions and wars in some of the regions, supply chain disruptions that affected the supply of critical commodities, and of course the extreme weather conditions. And I think we all cannot overestimate and overstate the fact that we are facing the effects of climate change, and that feeds into the economy and the financial sector. The slowing down of some of the regions such as Japan and US, and now some notable recoveries in Europe and China. So there's sort of mixed performances across various regions. But amidst all that, the economic developments in the domestic economy really showed a lot of resilience, as we have seen, because recording 5.6% growth in 2023 was really remarkable amidst all the challenges that we continue to go through. But much more importantly is really to highlight the fact that services and agriculture sector continue to provide that rebalancing, that whenever we have adverse weather conditions, so we see services sector also pick up and support economic performances. But much more importantly also to highlight is the fact that towards the end of 2023, we saw some slowdown and softening of economic activity. And of course, this reflected the high inflation that we had in the country, which was also came in very strongly to boost production costs. I mean, in terms of increasing production costs, but at the same time also lower the consumer demand in the economy. And of course, all that, whenever there is a reduction in consumer demand amidst increasing production costs, the economy slows down. But in 2024, we've seen, particularly in the first half of the year, we had ample rains. But now we have erratic weather really characterizing the economy. But also emerging amidst all this is really the financing constraints that we continue to see, because we all recognize that the fueling of economic activity really comes in from finance, and finance really sits pretty well in terms of supporting economic activity in whatever sector that we're looking at. So a number of occurrences and aspects that continue to shape the banking sector performance in 2024 include, apart from the pass-through of global and domestic economic environments, is really the evolution of non-performing loans that we would want to highlight more. But much more importantly also is the trends in the monetary policy and fiscal policy in the country. And of course, that has implications on the financing risks as well as also the credit performance in the country. When we look at it either from the standpoint of the downgrades we have seen, or also the evolution and the growth in the domestic credit to the private sector. So just to dig deeper into the banking sector performance in terms of the growth aspects, the risks and the mitigations that have been deployed, when we look at the growth, we have seen a very notable growth in deposits mobilization in the banking sector. And of course, this has been enabled by the strategies that banks have actually adopted in terms of mobilization of deposits. So through the mobile and online banking platforms, and as a result of increased deposit mobilization, because banks are in the business of financial intermediation, so converting deposits into loans, we've also seen a very strong asset growth, 18% growth in assets. And half of that, nearly half of that, is really in private sector loans. But even with this, there were a number of risks that really continued to shape banking, and all bankers are watching the evolution of the NPLs in the market. And we saw it increase from 2013 to 2022 to 2023 to close the year at 14.8%. And of course, there was also exchange rate risks, because in any event, whenever there is movements in the exchange rate, then there can also be repricing of assets, because the sector continues to hold private sector credits. Up to 30% of it is actually accounted for by foreign currency denominated loans. So any movements on the exchange rate also had an implication on the performance of the overall credit to private sector. But with increasing NPL's position in the market, there were mitigations, because banks took caution that they needed to avert a further build-up in NPLs in the market, and of course, to prevent that from affecting the stability of the banks, there was increased provisions to cover for expected credit losses, and banks also adopted more robust collection strategies to be able to ensure that most of the loans do not actually translate into non-performing loans. But overall, also, we saw strengthening of portfolio management strategies that really helped to a great extent to minimize the NPLs from escalating further. But amidst all this, now that we've not seen major issues and threats to the banking sector stability, because there are some comfort cushions, so to say, in terms of very strong capitalization. And as much as the regulatory standards require that total capital as a ratio of total risk-weighted assets should be at at minimum 14.5%, we saw banks posting on aggregate 18.6%, meaning the sector continued to enjoy some strong capital buffers that could enable it to carry any risks, including the NPL positions that actually came up. Liquidity positions were also quite ample in terms of we saw average liquidity ratios at 51% against a minimum of 20%. So more specifically also, as I mentioned earlier about increasing provisions, is that over the period, 59% growth in provisions. So banks took extra caution in terms of covering for expected credit losses. And of course, as a result of that, that ensured that the sector remained very stable. So also the provisions that were increased covered up to 17% of the NPLs. From 14% that we saw in 2022. So there was extra caution demonstrated from that point that as NPLs continued to increase, banks needed to provide for expected credit losses to a greater extent. But also other developments in the sector included an appreciation by the banking industry that we needed to invest more in the long-term value of banking, and more so in the economy. Through our sustainable finance initiative. As you may recall, in 2016, the Kenya Bankers Association launched the Sustainable Finance Initiative, which was actually to champion banks to be able to embed sustainable finance practices within their operations. And as a result of this, we have been doing a lot of capacity building, as well as also championing the industry. And banks have been very ready to actually translate their operations, not only to focus on financial gain, but also the social transformations in the economy, as well as also ensuring that our environment is actually sustainable. So we did a number of trainings, and banks really showed a lot of commitment to be able to translate their operations to be more sustainable, and that continues to deliver long-term value for shareholders as well as also for the economy. So trainings in such areas as circular economy, investments by SMEs in the country, ESG reporting by banks to be able to embed environmental concerns, social concerns, and of course promote good governance of our banking institutions, as well as general financial literacy programs for MSMEs in the country. But in terms of the bottom line, at the end of the day, profitability indicators for the industry continued to show some form of resilience. And this is important to mention that amidst, if you were to compare banking industry like with the telecommunications industry, the manufacturing industry, and even the energy and petroleum industries, we continue to post some modest performances over the year, particularly in 2023. The average return on assets for the banking industry was 2.9%. And this continued to remain lower if you look at it relative to the telecommunications industry that posted over 20% return on assets, and manufacturing sector also over 10%. So this is against common perceptions in the economy that bankers are making so much money. But if you look at it relative to the investments and the capital that is actually channeled towards banking, 2.9% appears very modest when you compare to returns in other sectors. Return on equity also was second to telecommunication sector, so we had 22.3% return on equity, as telecommunication sector posted over 40% in return. So this is a reflection of an industry that, amidst the balancing of economic challenges, amidst the risks that actually continued to face the economy, we were still able to convert the opportunities that are available in the market, and balancing again with non-performing loans that were growing in the economy, the sector continued to post some modest returns to its shareholders. Now, looking at 2024 and beyond, in terms of our outlook, we see a picture that is painted of what we can describe as cautious optimism in the economy. But this is anchored on a number of things. One is the developments in the fiscal policy. We see it being heavily constrained, and of course that continues to be anchored on a number of developments that we have seen. Of course, earlier in the year, I think it's not news, about the withdrawal of Finance Bill 2024 meant that the financing conditions for government are going to be altered in one way or the other, and now the revenue constraints that continue to face the government meant that there is going to be one option. One is to reduce on expenditures. And I think that this has elicited a lot of interest amongst the public on what exactly this is going to mean. But from an economic performance standpoint, we are likely to see then a reduced contribution of government into economic performance, because as government rationalizes its expenditures, then that means that economic performance, that contribution from government is going to be muted. And therefore, there is a greater challenge on the private sector to be able to deliver the growth that we so desire. But then amidst that, then we would look at what are the other conditions that would actually make the private sector come out strongly and be able to deliver that growth. So those financing risks, particularly on the government side, are likely also to be passed through to some of the corporate investors, and we've seen underperformances on some of the of the borrowing instruments on the side of government, and of course, let alone the infrastructure bonds, the other traditional bonds, underperforming because of the financing risks that now continue to shape both government and translating into some corporate investors. Downgrades also on the side of government, that also being translated into the banking sector because of the exposures that banks have on government. And of course, this has an overall impact on financing costs and risks at the end of the day. So with elevated financing costs on the side of government, that also means that the trade-off between investing in government securities as well as channeling loans to the private sector would actually have to be considered in that particular space. Then there is the issue of the monetary policy, because the anticipation was with increased inflation last year and tightening of monetary policy, then there was the increase in the central bank rate to 13% that we have now seen, and now that has started to reduce, but the pace of its reduction has actually started off in a very, we saw the signal, the 25 basis points cut on the side of government, on the side of the policy rate, and that of course means that we are still within the higher interest rates regime for a slightly longer period, because there is a wait and see on what would happen, for instance, in advanced markets such as the Fed. And of course, with increased elevated interest rates, then that means that there is weaker demand for loans, because all the borrowers are approaching the situation with a wait and see consideration, particularly in terms of their investments that they would want to deploy. So as that happens, then it means low demand on credit to private sector. Again, the financing of economic activity also slows down. Then the tighter lending standards we've also observed in the banking sector. As a result of the elevated NPLs in the market, banks have engaged tighter credit conditions to be able to avert a further buildup in NPLs. And that also has implication on the overall rollout of the credit to private sector. But amidst all this, the dilemma and the trade-offs with the monetary policy making organs would be, one, the need to actually be able to support a private sector-led economic growth, but also through a cut in the interest rates, but also at the same time is to watch and say, what would a cut in interest rates mean for exchange rate stability, and that remains a very a very critical trade-off that would have to be balanced quite strongly, and with a stronger focus on what implications it would have on the general economy. But also, as interest rates remain elevated, the financing costs on the part of government remain also heavy, and that has implications on, one, debt service ratio, and also the debt sustainability at the end of the day. Then the credit growth prospects also remain anchored on a lot of uncertainty, particularly, one, on the pace of rate cuts that we are now anticipating, and the trade-offs that I've mentioned, as well as also the pace of the asset quality. Now, this is the NPLs positions in the market, which continue to really weigh heavily. So credit performance overall would have to be dictated and by either those two aspects. One is interest rates, and two is really the pace of non-performing loans in the banking sector. And much more importantly, to highlight the issue around non-performing loans is really with financing constraints on the part of government. So the resolution of pending bills would actually be a critical aspect to watch, because when government is constrained on the liquidity side, even the promised resolution of pending bills would also have to slow down in anticipation, because of the constraints from the funding side. And that has implications on the non-performing loans carried by the banking sector. Then also, as a result of the increasing provisions, as banks take precautions on the non-performing loans in the market and increasing provisions, that also has capital vulnerabilities, because in the event that the loans actually, there are no recoveries on those loans, then banks have to take a hit on their capital position. So there are vulnerabilities on that side. But amidst that, of course, banks are strengthening their efforts to recover the loans, so that it does not really hit on their capital positions in the market. So we'll end it at that, at the risk of not saying everything within the report, so that we encourage readership of the report and be able to generate comments and questions aligned to this. Thank you and welcome.